Lastly, cash flows from assets. So what is a cash flow? You probably have heard me use the word cash flow so many times in this class, right? It's basically amount of money. That's all I really mean by it. But this term is used by people in finance all the time. The reason we say cash flow is because it's kind of very vague. It doesn't really tell anything about whether we mean money spent or received. So actually we can make it a little bit clearer if we say cash inflow or cash outflow. So cash inflow is some amount of money that is received, typically in some year. So cash inflow in year one means over the first year of some, project or whatever that is, we received the total of this much. Cash outflow is the money that was spent in some year. Why is it important? So what else is important? What important detail is embedded in the term cash flow? What's important is when we call something a cash flow, we mean that money is actually received or spent. Remember, we had depreciation in our income statement that we called a non-cash item. So we cannot call it a cash flow. Depreciation is not a cash flow. It looks like a cash outflow, but we do not actually spend it. We only need to use it as if it's a cash expenditure, so that we can calculate our taxes correctly. That's the only purpose. Then if you go back to a balance sheet, we can say the following. All assets that we are working with, buildings, equipment, and so on, they're all being used in order to bring cash flows, cash inflows, right? So these are cash flows from assets. And then what do we do with all the money that the assets generated for us? We spend it. We pay some of it to our creditors. So liabilities is like cash flows to creditors over the years. And then the rest goes as payments to stockholders, such as dividends. So cash flows from assets equal cash flows to creditors plus cash flows to stockholders. So this is something that you would be able to say for some given amount of time. So let's say within a year, within the most recent year, this is how much money our assets brought to us, how much money we made, like a profit, right? And then within that same year, we spent some of it on paying back to creditors and the rest to pay money back to our stockholders. And creditors and stockholders are two sort of groups of investors that have interest in our firm. So they have like stakes in our firm. They provided money to us so that we can give them the money back with the some return on top. So cash flow from assets are cash inflows. Cash flows to stockholders and creditors are cash outflows. And this little formula is known as cash flow identity. The cash flow from assets are also called free cash flow because the firm is free to distribute it between creditors and stockholders, the investors that have stakes in the company. And Chapter 2 kind of flows well with Chapter 10, when Chapter 10 is covered right after Chapter 2. And so what you will see in Chapter 10 is how exactly do we calculate cash flow from assets for some particular year. And remember, this is basically nothing but profit. So how do we calculate profit for this year and the year after that and another year after that? That's all in Chapter 10.